So, hello and good afternoon. I welcome you to today's Trading Spotlight webinar here together with Admiral Markets. My name is Klatt and I'll be the moderator here for the upcoming 45 minutes around. We'll dig into a very, very interesting topic. In fact, the four most important Forex economic indicators. And I'll introduce to you those four main drivers. In fact, while we certainly have to be a little careful right now in the current market environment, driven by COVID-19 lockdowns around the globe, in fact, and other potential market developments currently playing an even greater role, and the short-term reactions to big prints in one or the other direction here, not creating the kind of reaction in the underlying assets, respectively, not creating the kind of volatility one might assume would usually happen. By the way, if you're currently watching this, I mean, it's an event. Probably you watch this 1 year from now. Today it's the 27th of November, 2020. So that might not affect you, but probably here are some interested within this webinar, currently looking at the developments in gold. This is crazy. This is crazy. So we have to remember it's Black Friday. It's a shortened trading day in the US. So equities, cash markets are closed. So futures will close at already 7 p.m. German. So this is 1 p.m. Eastern time, New York time, and usually don't expect big volatility. And the drop on the downside is mainly driven most likely due to the thin market environment, but there's also other developments which are currently not making any sense at all. When looking at the fundamentals, that's the reason why I mentioned this. When looking at the current fundamental situation, when looking at the developments in the US dollar right now in yields, for example. So what we will do, I can assure you that we will do this in the upcoming minutes. I will give you a quick overview, also the current market situation and what to make out of this price action. And by the way, I would very carefully watch the region right now around 1,750 to 1,760 US dollar. I think this is a very interesting level, especially if there is no such thing as the US dollar now selling off to, or respectively sharply rising in this context, respectively US yields sharply rise. If this does not happen, I don't consider this move on the downside to be sustainable, and could imagine the market to push higher, even though there is potentially a driver behind this, which is not fundamentally given, but who is more interested in keeping his power of the especially paper gold market. But this is something we will dig deeper into in a few minutes. So first of all, let's have a look here at today's agenda. I'll introduce to you the four most important Forex economic indicators I look at. First, it's GDP growth rate. Then we have interest rate decisions. In this context, we'll also dig a little deeper in this context into how does a central bank find out where to put their yield level. In fact, what indicators do they take into account here? In fact, there is a theory, the so-called Taylor rule, which I will share if you watch this on YouTube now in the description box, respectively. I will share the link once we open the slide here in this presentation. And you can see there what central banks take into account to define which interest rate level is appropriate. And that's one of the reasons why it's definitely worth to look at this, especially if you're trading Forex. We will have a look at the employment numbers. So today is Black Friday, as I already mentioned. It's Friday. Next week is the first Friday in the month. And next week, we will have the employment situation being published again, non-farm payrolls, unemployment rate. So we will dig into this very important Forex economic indicator here within this webinar today. And then we'll also look at the inflation rate, which will be published in a few weeks from now in December again in the US then. And at the end, I will show you, and that's why we'll head over to the MetaTrader 5 in this case, but also available for MetaTrader 4, the Admiral Markets Supreme add-on economic calendar in this case, where you can display the most important economic Forex indicator events, news events, right into your MetaTrader, in fact. Before we start, Yeah, as I already said, my name is Jens. I'm located in Berlin, Germany, by the way. So this is especially noteworthy because the broker behind this Trading Spotlight webinar series, Admiral Markets, has in fact offices around the globe, 20 offices and more around the globe, and is a financial service provider in this industry. Next year as a birthday, it's not 18 years, but it's 20 years then. And so this year is the 19th year Admiral Markets is in this CFD and FX industry, but and not only limited, the offering from Admiral Markets is not only limited to FX and CFDs, but also to physical stocks. So it's a true multi-asset broker. Definitely worth giving Admiral a deeper look. AdmiralMarkets.com. Highly regulated FCA. Due to the Brexit, there's also a necessity that there's a SISIC regulation. If you're watching this now from Australia, there's also an ASIC regulation, for example. So highly regulated broker, 20 offices around the globe and more. And yeah, feel free to reach out. Here in Germany, we refer to Admiral as the so-called DAX expert with the potentially most competitive offering when it comes to CFD offering, DAX CFD offering here. Trading conditions, commissions, cost of trading, cost of doing business, but also when it comes to FX trading, for example. So Admiral is definitely worth giving it a deeper look, admiralmarkets.com, for further information. And by the way, you have to reach out to this website once you want to have this supreme add-on. We will make a theme in a few minutes. So yes, good afternoon. I'm sorry. No, everything fine. Everything fine. So hello from my end. I'm just checking the chat box here, and there was someone who thought my name was Ronald, but my name's Jens. Yes, but everything fine, no worries. So let's have a look at the first Forex indicator or economic indicator I consider to be of high interest, in fact, when trading FX. It's the GDP growth rate. GDP growth rate means nothing more that we measure the economic growth, which is represented by the economic indicator called GDP, gross domestic product, in fact. And it's calculated here by calculating the value of production for any country during a specific period of time. So what you will usually see when you look at the numbers which are published then in the news wires around the globe, if you look at it, Twitter or wherever, you will see that there's MOM or YOY. And what they usually do here is they measure GDP based on quarterly or yearly growth, in fact. So in comparison to the quarter before, respectively, in comparison to the quarter 1 year ago, and how the gross domestic product did, in fact. And this is currently very interesting, in fact, because once we look at the numbers which are published around the globe after the Corona lockdown, very interesting numbers, because now one might say, wow, we see tremendous economic growth. We will see, by the way, a very important a number, and we will see, even though when we switch over to trading economics in a few seconds, you will see it's India's GDP we look at here at this context, but it's right at the starting web page. So that already indicates it's a very important Forex economic indicator, in fact. And now let's coming back to the numbers, year on year, quarter on quarter. If we look here at the numbers which were recently published from the US, for example, one might have said, and that was also something which Donald Trump used as a tool during also the presidential race, potentially saying, well, look at how great our economy did. And here are the numbers which came in at, I think, 36% or something like that, which is in fact a tremendous amount, tremendous number, no question about that. The only problem is if your economy dropped by 33% the quarter before, well, you now have to make 50% to at least break even. And why do we know that? Because we as traders can perfectly see where the problem comes into play. Just assume we have a 10,000 euro account. We are, well, I don't know, lose 33% or something, and the account drops to 6,666 or 67 euros. Well, we now have to make 50% to break even again. And so the numbers itself are not very phenomenal right now, but in fact, they are pointing to further potential further economic downturn ahead, in fact. And what we usually do is we consider GDP to look at it from a perspective like we say, hey, rising GDP, that's usually a positive sign. And that means that the domestic currency will potentially see some kind of strength in the months ahead. Main reason for that is because you can look at the currency, or in the Forex universe, you can look at the currency as kind of a share or a stock of an economy, in fact. So if you want to bet on the, I don't know, let's say European economy, you buy the euro. If you want to bet on the US economy, you buy the US dollar. It's like a stock of the economy. And if you see high gross domestic product numbers, if you see great growth rates here, well, what you usually want to do is you want to bet on the economy, because to avoid so-called overheating of the economy and to dampen the inflationary outlook, what the central bank will usually do is they tend to hike rates, which means nothing more than you get a higher yield by investing in the respective currency here. And this is something which is currently not the case when looking at the recent example I just brought up with the U.S. economy for Q2, Q3. Let's just look up the numbers in a few minutes. I think it was Q2. No, Q3. Q2. There was this breakdown, massive breakdown, and now we saw the reversal Q4, Q3. Yeah, sure, certainly. Yeah, so that said, in fact, usually you look at GDP numbers or GDP as to be a positive, to have a positive tendency or initiate strength within a currency if you see numbers which can come in significantly above expectation. And as a result, one second here, this is the point. As a result, what you see is that investors have to buy, as I already said, pointed out, the domestic currency, which will naturally result in the value of the domestic currency to increase. So therefore, let's now have a look here at a website I already opened. There we have it already. It's India. In fact, GDP shrinks less than expected in Q3. So that alone already points out if this is worth a headline on a website like Trading Economics. It obviously illustrates that GDP is obviously a very important number we have to look at here. And still, what we want to do is we want to here have a look at indicators and countries. And there, click on United States. And there you see GDP growth rate with 33.1%. That was what I just referred to. And there we have it. So I was 33% down, and then 35, 36 on the upside. Okay, so it's just only 31%, 31.4 here in Q2. And then we see this reversal to 33.1, which is no big surprise, but still points here, and this is pointed out there. However, GDP is still 3.5% below its pre-pandemic level. And although a coronavirus vaccine is expected to be ready soon, the pandemic is far from controlled, in fact. So this is what Trading Economics highlights here. And yeah, so that's the first source you should look into once you see a number being highlighted as highly important in the economic calendar on admiralmarkets.com. You can find it here under, analysis here, analytics, and then click on Forex calendar. This website opens, but this is something which is already filtered or individualized, let's call it. So what you can do here in the section of the Forex calendar is you can look at the time span you wanna look at here. In this case, I looked the whole month of December, so the upcoming month in this case, from the 1st of December 2020 till the 31st of December. All in all, we should expect the economic docket to be quite thin, let's say, even though on the 24th, so one day before Christmas in the US, here we still have a quite significant news event called durable goods orders. Numbers around the GDP were published last month, by the way. So let me just see whether I can, let's just do this. So I take 2 months now, And oh, I'm sorry. Yeah, okay, that doesn't work. So I just thought that I can also see numbers from the past, in fact, and these are taken out. Previous is past data. Oh, let me just see. Let me just see. Probably it's possible, but it's too much data. I just wanted to look at here. That's probably no, it's not working. not working as expected. Probably there's a chance to highlight it also for the past, but usually what makes most sense here in this context is to have a look at the future events. And if you want to analyze especially the past, therefore I then would here point to tradingeconomics.com, free source with all fundamental data, not just on the US but also on other countries. So you can here click on countries, and there you can see it's the whole world, in fact. And even if you're interested in, let's say, Australia and their Papua New Guinea or Samoa, for example, you can look up the GDP growth rates there. You can have a look at their current account, for example, and all this. So there's plenty of fundamental data available on tradingeconomics.com, and I highly recommend checking out this website for further information. So now let's head over to the next slide. From GDP growth rate now to interest rate decisions. Oh, by the way, let me just do the following here. I'm sorry. Let me just share this link in the chat box. I think this makes sense. So I call this TE for Trading Economics. By the way, I see we have someone here from Colombia, from Belarus. We have someone here. So by the way, you can also look up these numbers, by the way. So Europe, there we have it. There we have Belarus. Let's open the tab here. And then Colombia. Let me just have a look here. Where do you have it? There, Colombia. So it's America. So here it's Belarus, all the numbers. GDP annual growth rate, minus 0.2%, unemployment rate, 0.2%, inflation, 6.2%, and so on and so forth. Current account, balance of trade, coronavirus cases. Okay, this is new. Here, this is Colombia, some more data, in fact. Here we have also coronavirus cases, coronavirus deaths, retail sales, inflation rate, whatnot. So you can look up all the data here on Trading Economics. It's a fantastic tool. I'm not saying that trading the Colombian currency, I think, by the way, let me just see. The currency is the Colombian peso. Yeah, perfect. So I didn't want to say it, but I was quite sure that's the Colombian peso. What's the currency in Belarus? I don't know this, by the way. What do we have here? Oh, Belarusian ruble. Okay, perfect. So yeah, it's probably not the most liquid currency pair or currency, in fact, when you trade it against the US dollar, but even this is something you can look up here. So how the currency is currently trading, in which environment it finds itself. And now let's come back to the presentation. So now let's have a look here at something which is really very interesting, in fact, when it comes to interest rate decisions. I mean, right now we're not talking about yields and rising yields, for example, or the central bank of this and that country rising rates. Sometimes there is some surprising news. Let's say the Turkish central bank just hiked rates. I don't know by which amount, to somehow make it more attractive to leave the money in the country and for investors, and not having investors taking out their money from Turkey due to political instabilities, for example, due to the economic downturn we currently see there. But all in all, we are in a very special environment. So what we have an environment in which we especially talk about special ways to manage an economic downturn due to QE, for example, expansion of the balance sheet of the central bank, buying bonds, for example, keeping yields at a low level for an extended period of time, give out a forward guidance, a very dovish forward guidance most of the times. Still, there's some very interesting aspects in terms or in regards to interest rates, which probably not many are aware of. And we are all aware of the fact that central bank decisions, monetary policy decisions, central bank decisions in case of the ECB, the next will take place on the 10th of December, so 2 weeks from now, or yesterday, 2 weeks from now. And we have in the US also an interest rate decision, if I'm not mistaken, on the 16th of December. So there, the Fed will decide on the interest rate level. There will be no surprises, but still, some might wonder. And we all know that this is a very important economic event. You can see every news ticker highlighting such a central bank decision, but still, some of you might wonder, well, where does this interest rate level come from? How do they get an idea on where to put the yield right now, or if there's an, let's call it, normal economic environment? And so before we look at this, the so-called Taylor rule, which delivers here the theoretical idea of fair yield levels, in fact, and I will give you a link to Wikipedia to check out further details on this. First of all, let's have a look here at interest rates in general. So when it comes to interest rates, we speak about the potential yield an investor, respectively a buyer of a currency, can expect to earn, respectively has to pay, if he wants to borrow money in the respective currency. So, and if a central bank decides to increase interest rates during, for example, times of significant economic growth, as I pointed out in the slide before, when it came to GDP, in terms of gross domestic product, naturally, it should result in higher demand on the local currency in order to get higher returns and vice versa. So if there's an economic downturn, yields will be lowered to make money cheaper. So yield is the price you pay for money, and you want to have a cheap currency. There's more demand resulting out of this, which will naturally result in more money than during an economic downturn being used to buy goods or to invest or whatever, to revive the respective economy. The only problem with that is it's just a theoretical concept. It's mainly, let's call it, Keynes based, let's call it. So John Maynard Keynes is the main driver behind this theory. In fact, the only problem with that is it's not taking into account behavioral aspects. So, or put it differently, when looking, for example, around in Europe, what we know is we can make the money as cheap as possible, and even you can turn yields into negative territory. It does not necessarily result in investors / in case of business people, businessmen, to say, well, great, money is cheap. I take the money, I invest it because money is cheap. Because the thing is, you have to have a positive attitude in terms of the overall economic outlook. Your expectation in regards to an economy has to be positive. If that's not the case, you can then make the money as cheap as you want. It just that no one wants to have. There's no demand for this respective currency. The same is true the other way around. You can hike rates to up to the sky. So let's put it simply. I mean, if you are now working at a central bank in Turkey, and they say, well, you know what, we pay you, let's say, 1 year, 20%. It's great. Yeah, I mean, we would like to have in our savings account 20% yield. The only problem is, why has a central bank to hike rates that massively? Well, what they want to avoid is capital being taken out of the country and investors fleeing with their money. So that's one of the reasons why they do that, quite simply speaking. I mean, it's very rough, but still, at the end of the day, that's all it's about. And so the thing is that these theoretical concepts usually do not take into account behavioral aspects, which we can currently perfectly see. And whatever a central banker you might listen to in interviews, I mean, it's more and more the same rhetoric being used over and over again. Yes, inflation is subdued, but still we see signs of positive economic activity, blah, 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 blah. It's some theoretical stuff they are presenting to the people, which has not necessarily something to do with the overall environment, the overall BS you can find, especially around investors when it comes, for example, to the European economy, but the same is also true for the US economy, for example, especially now after the economic downturn or the recession we find ourselves in due to the corona lockdown. And so now what we want to have a look at here is at this so-called Taylor rule. So the Taylor rule, which delivers the theoretical idea of a fair yield level. And what we have here is the Taylor rule going back till 2019, in fact, suggesting the fair level of yield that was before Corona hit. And what we can see here is the ECB interest rate, which obviously diverges quite massively from the theoretical value of the Taylor rule, which it suggests here. So before we continue, let's just head over here to the Wikipedia article I already prepared. So there we have it. And let me just share here Taylor rule, the link for further information, but I will guide you through the first 3 articles here. So Taylor rule is one kind of targeting monetary policy used by central banks. The Taylor rule was proposed by the American economist John B. Taylor, former economic advisor in the presidential administrations of Gerald Ford and George H.W. Bush. In 1992, he introduced this as a central bank technique to stabilize economic activity by setting an interest rate. And the rule is based on 3 main indicators he takes into account to consider, to find out the fair value of an interest rate. So first of all, it's the federal funds rate, then the price level, and the changes in real income. And the Taylor rule prescribes economic activity regulation by choosing the federal funds rate based on the inflation gap between desired targeted inflation and actual inflation, in fact, and the output gap between the actual and natural level. And according to Taylor, a central bank implements a stabilizing monetary policy when it raises the nominal interest rates by more than an increase in inflation. In other words, the Taylor rule prescribes a relatively high interest rate in the situation when the actual inflation, blah, blah, blah. This is now getting very, very theoretical. So the thing is, this is a first idea of where does the interest rate come from, a central bank introduces. And now what's certainly of interest in this context is then what happened here. So where's the problem right now? Well, the problem arises from the fact, especially when it comes to the European economy. I'm not saying that if they hiked rates earlier, that they now would have a great arsenal or a great toolbox they could use to revive the economy, which is heavily shaken and smashed down by the economic downturn resulting out of the Corona lockdown. This is not what I'm saying. But if there was no Corona lockdown, we still would face potentially the same issue with a potential economic downturn, which is now triggered by Corona, but is just the trigger event. So that we will likely get to see. Let's not just look at the European Union here, but let's look at the US, for example, that there will be a recession that could have been foreseen by the fact that there was, for example, this inversion of the 2 and the 10-year yield curve, for example. So also here, yield plays a very important role. Some of you might have seen that 2-year yields paid higher than the 10-year equivalent. So the only problem here was then that such an inversion usually points to the central bank currently hiking rates, as the Fed did over the course of the last years, before then stopping and last year in July cutting rates aggressively, most likely due to anticipating what happened then in the repo market. But this is a little too much in this context. But what we saw is this inversion usually points to the central bank hiking rates, while longer term investors do not expect the economy to grow strong enough so that a higher yield level is warranted. And in this context, there's an inversion pointing to a potential recession. This is what we got to see. So there was already this tendency. And now the question arose, not just in terms of the Fed, but also in terms of the ECB. Probably they kept rates too low for too long. And this is something which this chart here perfectly illustrates, in fact. So while the Taylor rule in case of the Eurozone and the ECB, already suggested hiking rates here from 2015 onwards. That was the starting point from QE, if you remember. So in 2015, in January, once the SNB abolished their peg of Euro Swiss franc, they did this because they expected, or they already anticipated, massive monetary stimulus from the ECB, keeping rates at a zero and negative yields level, in fact. And so while Taylor, based on the economic indications, already suggested hiking rates, the ECB kept rates low, and in addition to that, added further fuel to the fire potentially, or into this explosive cocktail, let's call it, by keeping interest rates too low for too long, and currently adding to the problems we face from a monetary perspective here within the Eurozone. So all this given, I mean, this is for some probably a little too complicated. If you hear this the first time, I highly recommend reading this article on the Taylor rule and also digging deeper into this concept of interest rate decisions, because it's very important, not just to understand the basics behind this and how naturally it should work, let's say, in a normal economic environment. But in addition to that, you can also understand why the market reacts at some points differently to rhetoric, let's call it nuances, you will sometimes hear in the rhetoric being used from central bankers, and especially at such rate decisions. So, and next, very important Forex economic indicator, interest rates in this context. And in this context, also highly recommended here reading the article on Wikipedia on the Taylor rule. So then next week, we have once again numbers on the employment situation. And the unemployment rate here. Unemployment rate is the number of unemployed people from the workforce in any country. And it's an important indicator which should be interpreted very carefully, as it is one of the main drivers of economic growth. Certainly. I mean, the more people have a job, the more people have potentially more money, meaning consuming potentially more, meaning that the overall economy should flourish, let's say. And thus price movements in the underlying currency, once these numbers are published, should be expected. And a rising unemployment rate here potentially means that the economy slows down and vice versa. So in this context, now what we want to do is, wait a second. Over here. Okay, I see. Okay. Yeah, one second. Let me just switch over here. So now we have the economic calendar. And here we have the non-farm payrolls, which will be published next week. So what's also interesting, if you click on this, by the way, you can get a first overview here on how things developed over the last, in this case, 12 months, in fact. So it's a 12-month indication. The only problem with that, I'm sorry, it's not 12 months, but it's more like this. It's 2015. I'm sorry, I didn't see here 2000. So it's 5 years. It's 5 years history you can see here. And so these are the numbers, non-farm payrolls, which are published. But what's of more interest, in fact, is if we switch here to the medium important news events. Let me just see, where do we have it? December, Friday. Unemployment rate. There we have it. So this is numbers on the unemployment rate, which shot significantly higher due to the corona lockdown, many people losing their jobs also in the US. And now the numbers are dropping again. And this is usually a positive sign, no? I mean, usually we would say, well, great. If we saw such a huge spike here on the upside, and now we're drifting significantly lower, even to below 10%, this is usually a positive sign. This is certainly true, but the problem with these numbers is that they're, at least not right now, that they're not correct. So once you now see numbers, there has been a time, I mean, I'm in this industry for quite a while now, and there has been a time once non-farm payrolls were published where you really saw massive volatility, and also where you could really rely on the data which was published there. Even, let's say, especially, or not especially, but probably more than you can currently rely on the data which is published there. What do I mean by that? Well, if you carefully read through the report, which is published here, the non-farm payroll report, and then the statement from the Bureau of Labor Statistics, the BLS, which is going hand in hand with that, what you can then see is that there is now a COVID-19 paragraph included at the end. No one is reading till the end such a report, remember, believe me. But I haven't prepared one, but in 1 week from now, I could prepare one respectively. I probably tell you, reach out to Google, Bureau of Labor Statistics, and then the report there. Or check out my Twitter account, probably I shared next week, whatever. There's one thing I want to point out here. If you look at the paragraph, the COVID-19 paragraph, what you will now see there is that the Bureau of Labor Statistics, the office which releases these employment numbers, points out that the numbers are most likely not correct because there's some people being counted as employed, which are under normal circumstances should be considered, let's put it that way, unemployed. It's a question of definition due to all the relief packages which were already brought on their way in April, May, so-called PPP, for example, the pandemic protection, payment protection. I think that's what this name was. And all these different definitions make it very hard now to say whether the numbers which are published there are correct or not, which makes it very special right now. But if you look at it at a purely theoretical or look at it in a normal market environment, let's put it that way, usually you have with the employment numbers or unemployment rate one of the most important news releases in the FX markets, which is known as the non-farm payrolls, which is released every first Friday of each month. And then here in this context, you have information on the employment situation in the US. So it should be considered as one of the most important economic indicators from Forex traders after GDP and interest rate decisions. I tell you, there has been a time once these numbers were even more important than GDP numbers or interest rate decisions, because they were a potential indication of what will the next step of the Fed be during their, for example, taper, which took place from 2014 till 2015. 15, 16, I'm not really sure, until they then started to hike rates again. And if numbers were better than expected, usually that indicated that there's probably a more hawkish approach, a more stricter monetary policy from the Fed than if numbers were bad. So, and this was potentially a driver for volatility, but this massively changed, especially in the current environment where the numbers are in fact not even creating a small move in the market. So I can assure you, there you have a chart, a news release here in this case. What we have here is euro against the US dollar on a 15-minute time frame. And that was the news release. I'm not even sure when it was. 119. Most likely it's quite a while ago, in fact. So we are right here again at this level. But the thing is, the last news release, we trade significantly below 119. But you can see here, we saw volatility of nearly 100 pips within this news release, which took place here. So this is a snapshot. You can see it here, 4th of X, and then the 7th. That means that was a Monday, that was a Friday. It must have been the first Friday of the month. So this is the news release of the non-farm payrolls. And you see the elevated volatility. If you look at the charts next week, I wouldn't be surprised to see no spike at all due to the given reasons I just mentioned. So the numbers are probably not of high interest anymore. Still, you should be aware of it. If you're an FX trader, there's no question about that you should be aware of this news release. And then there's the inflation rate. We already saw it at the last slide, in fact. Not last slide, I'm sorry, the website from Admiral. Let me just switch over here and now go back to the filter, and there you will see that I'm taking this out, that here on the 10th of December, so 2 weeks from now, not really, yesterday, 2 weeks from now, the same day, once the ECB rate decision takes place, here you have also the release of the inflation rate, which is potentially of higher interest in the current environment, probably also interesting for gold. But this is something we want to point out in a few seconds. First of all, let's here look at it from a purely theoretical standpoint. So inflation rate is a term used in order to express the rate of change of prices of goods and services in a country. And in the following, an overview of how inflation rates in an economic calendar is in fact published. So there's CPI, Consumer Price Index, is published on a monthly basis, representing the rate of change in a basket of goods and services that are bought by customers. Or consumers. Then we have the core CPI. It's the same number, in fact, with the adaptation that it excludes so-called volatile goods like food and energy out of the equation here. So energy is obviously a highly volatile component within this number due to the fact that oil prices usually spike quite high and low, or can present themselves in a quite volatile way. Let's put it that way. And if you exclude this, you get the core CPI number. We have then also the PPI, which is the producer price index. This is usually published before the inflation numbers, or the CPI in this case, one day before, but can already give an indication of what to expect. So sometimes numbers of PPI are published and result in sharper volatility, even though they are not highlighted as high important news events in the news calendar, respectively in the economic calendar on the website from Admiral Markets. Why is that? Well, because here it measures the rate of change in prices of inputs and outputs of goods at factory gates. And now the thing is, let me just go back here. Now the thing is, the higher PPI is, that means nothing more than if the producer has to pay a higher price, he will naturally increase prices, which will naturally result in higher consumer prices, right? So if this number is published before and not highlighted as highly important, but results in elevated volatility, you get a quite good idea on what market is currently expecting. If numbers on PPI are spiking higher, market participants, if you see elevated volatility in the respective currency pair, usually expect the following day the CPI being published higher too. If this is not the case, you can see a spike higher on, let's say, Wednesday, and then you see a price push lower once this number is not confirmed in the consumer price, probably even coming in below expectations. And so this could result in 2 days of elevated volatility, even though there's no clear trend developing, but you see at least quite volatile price action. And here the interpretation of inflation, it depends mainly on the economic cycle. So in case of the recovery like 2008 or before 2008, for example, when the inflation rate was increasing, investors expected central banks to increase interest rates, which resulted in the respective domestic currencies to rise, okay? So in case of an economic depression, now, like we saw, for example, after the great financial crisis between 2009 till 2012, or today, okay, decreasing inflation is interpreted as negative. It's a deflationary tendency we get to see there, since it points to a sluggish economic growth, and even small upticks in inflation are only the result of monetary stimulus, respectively a devaluation of the underlying currency. So there has been a time several years ago, 2-3 years ago, once there was a slight uptick in European CPIs, for example. So Euro CPI pushed to over 2%, but that was mainly due to the fact that there was a huge depreciation or monetary policy resulting, or monetary stimulus resulting in the euro to drop, which then meant nothing more than importing inflation due to higher energy prices, for example. So that's it on the four economic indicators I'd like to point out: GDP, unemployment rate, respectively, employment numbers, interest rate, and inflation rate. And now the question is where to find the supreme add-on package for your MT4, MT5, respectively. Why is that of importance? Because this can display these news events within your chart. So we go to admiralmarkets.com. There we go to platforms, and here we click on MetaTrader Supreme Edition, and there you have the screenshot, respectively. Here, I can also show it to you. If you go to admiralmarkets.com and you go here to products, there you have the, let me just see. Oh, sorry, not products, platforms. I'm sorry, platforms. And there you have here the MetaTrader Supreme Edition. And this is where you click on. And there you can then download it for free for your MT5, respectively for the MT4. What I recommend to you, by the way, is downloading a demo before. If you have already an account, you can then log in here into the traders room. And in the traders room, you have then the possibility to download it there also. So there you can then go via the traders room to the download button and download the Supreme add-on here too. If you can include it as every indicator / expert advisor in your MetaTrader, and let me just here point this out. So this is the MetaTrader, and what you see here is you can include this. So you have the package then installed on your PC on the desktop. You can copy it into your MetaTrader environment. You just close the platform, and then you open it once again, and it displays here. And what happens then is that you can here look at the mini terminal, for example. So this is what you get to see here. Okay, this is the mini terminal. You can then increase your overall trading. How can we say that? Your trading life, whatever. So within the MetaTrader, so this increases the productivity and efficiency here of your trading massively. If you compare trading here with this mini terminal compared to the usually very difficult way to trade within the MetaTrader. And under indicators, you have here several Admiral Markets Supreme add-on tools, and one is the Admiral calendar. You can see it here under C, Admiral calendar. And if you then put this here on your chart and click on OK, this is what you get to see. It's all events now being displayed. And what I want to do, one second, let me just go to indicators, and there, oh, I'm sorry, this is not so cool. Let me go here. You can now say, I only want to see, what did I just do? 1 second. Usually it shouldn't, this shouldn't happen usually. 1 second. There shouldn't be two, by the way. So let me just do it that way. So there we go, once again. So now we go to indicators, and here we can now say past and future. You can click on this, and you will see that there's only future items only. So displaying the future events which take place. You click on OK, and there you have it. And then you can see here, for example, you have consumer confidence. In this case, in Japan, based on the fact that here we look at dollar JPY. You won't see this data happening if you now switch the chart to dollar CAD, for example. So if we go here, and now you can see there's no red highlighted event, but instead you have here current account from Canada. So it depends on the currency pair you look at. And you can display all news events here, and depending on the importance within your MetaTrader, due to this Admiral calendar tool, you can download here on the website for free. So just 1 second, let me just see. Okay. So this is how you get the Supreme add-on package, and how you can display all this data in your calendar. There's again a screenshot I've taken before. There you have, for example, the jobless claims. In this example, you've just seen how to introduce it or how to implement it in your chart yourself. So to get an overview of the upcoming news events. And in fact, that's it. So I promised you, nevertheless, I promised you to have a quick glance here at gold. So this is something we want to do in this context. So here the break lower, and there's, by the way, the region on 750 to 760. I have it slightly lower. So you probably wonder, and there's also a question: inflation rate in the US, if it's currently influencing the gold price. I don't think so, or at least not in the way you would expect it to. You usually expect, if inflation rates picks up, while interest rates stay stable, you usually see an increasing negative real yield environment. Negative yields mean you, for example, buy a bond in US dollars or US T-notes, for example, and then you get an interest rate of currently something like 1%. If you have inflation of, let's say, -2%, or no, not -2%, sorry, of 2%, that means that your real yield is -1%. if you invest your money. So on time per year, you should lose on average 1%. So now the thing is that gold usually is an investment or is an asset class which is under pressure. It should be expected to be under pressure if yields rise, if especially bond yields rise. Due to the fact that it's getting more unattractive to hold gold due to the fact that gold does not pay any interest at all. So now, if you have a negative real yield of -1% and you have gold with 0 yield, that means gold is more attractive. So the more negative the real yield is, the more attractive is gold. So now, currently, look at the current yield environment. You don't see any developments in yields at all. So yields are stable, especially today. So if you look at 10-year treasury yields and you look at the drop in gold, you only see gold dropping, but not yields spiking higher. Same is true for the US dollar. So usually we know, based on what I just presented, rising yields should make a currency attractive, more attractive. Currently not happening because yields are stable. In fact, the US dollar in the current environment is under pressure. So now put this into perspective. Does that make sense what we get to see? Something which was initiated, which started here with vaccine hopes being brought on their way. That was on the 9th of November, once Pfizer and BioNTech announced there's now hope for a vaccine, which will be available quite soon. And there was this hope resulting with returning to an economic normal and all this stuff. So now the interesting thing about this is this is not taking place here, right? So we don't see a back to economic normal due to a vaccine, but we know that there's lots of also thinking behind this, a behavioral component which plays a role. Yields are stable, but still gold is under pressure. So why is that? And my personal thinking here is that the main reason for this is it's a highly manipulated environment in which we currently find ourselves in. We don't want to dig too deep into this, but I think there are forces behind the scenes pushing paper gold prices lower with a target to avoid having trouble to deliver physical gold if requested, especially when it comes to the future price in this case. So you can see there's certain amounts or certain ideas you can formulate based on the input I just provided. It sounded quite basic for Forex main economic indicators you should look at. But if you understand them in depth and if you think about it a little, the push lower here in gold does not correspond, does not fit well into this whole picture. And this is something which is currently definitely of high interest, and especially, and then we come to the trading perspective, if we continue to see gold being under pressure, let's see if we can close below 1,800. I'm already thinking that probably that was just a short flush on the downside and we will return quite aggressively back above 1,800. I could imagine that. But if we continue to drop while the US dollar continues to sell off, while yields present themselves stable, probably dropping too, well, this is usually something I would say is interesting then from a risk reward perspective, especially now in the bullish seasonal window into the yearly close and also into the start of the next year, which could make gold a quite interesting investment here, and probably this push lower, probably even more interesting from a risk reward perspective then. And yeah, so that's it from my end. So now let's come to the summary, which points out what I just mentioned already. The 4 most important Forex economic numbers every FX trader should know are GDP, or respectively growth rate, interest rate decisions, employment numbers, unemployment rate, inflation rate. And if you want to get these important news events directly displayed in your chart, you should use the Admiral Markets Supreme add-on, which you can download here on the website, admiralmarkets.com, for free. And in addition to that, on the website, you can also check out the economic calendar we referred to several times during the webinar. Don't forget to join us next time. Paul will be here on Monday and we'll talk to you on how to trade rejection candles. What is a rejection candle? That's the first answer he will deliver. And then how do we identify them on charts, and how can we build a simple trade plan to include rejection candles? Check them out on Live Markets. And this is what you will get to see on Monday then. And it will be 2 p.m. London, 13th of November, Monday. Check your inbox for the webinar link for all the people who are here now in the live event, respectively, if you watch this on YouTube. I just hope that you enjoyed what you saw. Please leave a thumb up here. Head over to admiralmarkets.com to register for the webinar, the Trading Spotlight webinar series. It's completely for free. Here is the website, admiralmarkets.com. Here are the contact details. And as I mentioned right at the beginning, Admiral is a highly regulated broker. Here's the risk disclaimer. That's it from my end. All the best. Happy trading. Watch your stops. Have a nice weekend. Enjoy yourself. Stay safe. Stay healthy. Bye-bye. See you.